99% of indicators are completely useless. That's because it tells you what everyone already knows. It's already happened. For an indicator to be actually useful, it has to indicate what is going to happen. And that has to be backed by proven data. And so in this video, I want to share two very important things with you. Number one, a proven profitable trading strategy that again is proven to work over many years, and I'll prove it with the data. I'll give you the step-by-step breakdown of that system and an indicator that actually makes trading that strategy 10 times easier. Without further ado, let's dive straight in. So what you're seeing on screen right now is a trade that I executed with my members. And to prove that, this is our live trading performance. Every single trade that ever gets executed in our live trading floor gets documented in here. And you can see for the month of June, when this trade was executed, we returned 22.795 risk to reward. So it was a great month. And this is the specific trade that I'm going to share with you today. It's this one. This is the trade recap. It is from June 18th. And this is the exact trade breakdown, right? The before and the after. And again, you can see in the screenshots here that many other traders caught this exact same trade. And this specific trade is from one of my playbooks, which is in here. This is the last couple of years of data trading this specific strategy. We have 2023, 2024, and 2025. As you can see, it is extremely, extremely profitable. And so now I'm going to break down the exact rules of that strategy, how to understand them, and most importantly, what indicator that I literally cannot live without, the indicator that makes this so much simpler for me, simpler than it ever has been. The first step is M15 directional bias. That means that I can only trade with the trend of the M15. So how do you actually define your M15 directional bias? I use market structure. So at any given time, price is put in a series of higher highs and higher lows. So this is bullish structure. You can see price puts in a series of higher highs and higher lows. And if this comes to the point where we are now, we have a break of structure, we have a swing low and a swing high. We can only trade in direction of this trend. So I can only look for buys. If it's the flip side and we're bearish, for example, putting in a series of highs, lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, we are bearish, right? Indicating lower and lower prices. So I can only trade in direction with that trend after a pullback. Now, the reality is structure doesn't look that clean and that simple. A lot of the times you might get structure that looks like this. And now you have to depict that same logic using all of this different structure. For me, again, I use the external swing points, and I have a very specific mechanical rule that I use that tells me whether something is a low or not. Because in many situations, there will be times where, let's say price puts in a high and it gives you a low like this and puts in a new high. Now, this situation is so common. One person sees that this is a break of structure and therefore this is a change of character, and now they are shorting the market in here. Another person sees that this isn't a break of structure, which means this isn't a change of character because this isn't a swing low. Therefore, they shouldn't be looking for shorts here. They should actually be looking for longs. Now, which one of them is correct? The answer is, we don't know. It depends on their data. And for the most part, almost nobody has data to tell them whether this is a low and this is a high or not. But that is something that I have built, and is something, again, that I've built into an indicator that does this for me. So the first thing that I need to look for is the M15 directional bias. And the way that I use that is market structure. And a lot of the times, the market structure is a lot more complicated than you would like it to be. It's never this simple like this. So you can have a swing low, a swing high, and then for me, this would be the low, this wouldn't be the high, this would then be the high, and then low, and then high, and then low, and then high. And then I would be trying to buy from here. But many people look at this and they're like high, low, and now they're bearish, and now they're bullish, and now they're bearish, and now they're bullish, and now they're bearish, and now they're bullish. So how do we actually apply that into price, right? And how do we actually apply it from the specific trade that I took? For the most part, the specific trade that I took is actually really easy because we had this huge aggressive sell-off. It makes understanding whether we are bearish or bullish very, very easy. This strategy that you're seeing, it's built on very specific rules, which means if you don't follow the rules, you won't get these results. So I have a very specific market structure rule. If you don't use it, then you might be bearish for the day, but my rules indicate that I'm bullish and I just follow my rules. That's what gets me the results. So I can tell you, look, trade in the direction of the trend on the M15, but if you can't accurately find which one of those it is, then you'll just have problems. Because again, if we look at this, in this specific scenario, it's super easy because we have an absolutely huge sell-off on the 17th of June, which make it, by the time we come into the 18th, it's so easy to understand that we're bearish, right? Unless, for example, maybe you're someone who's looking internal. And now maybe you look at this and you're like, okay, well, we have, you know, a low, and then we have a high, and then we have a low, and then a high, and then a low, and a higher high. And actually we're bullish and you're trying to buy here, which would just be crazy, but some people would look at it like that. So yeah, this one example is easy, but what about in here? What makes a high, what makes a low? For example, is it like this, right? And then like maybe it's this high, and is it this low, and then it's this high, and okay, now are we bullish? Like, okay, buy, oh wait, no, sell. Without clear rules, you will just be guessing, and that's for the most part what most people do. So it's really important to have these rules. That's why one of the things that I built into my indicator is the structure. So this is built on my repeatable rules. It's not random. This is what I found. I looked for different market structure indicators, and they're all random. None of them were built on any specific repeatable way of indicating structure. They would just choose random highs, random lows. If it breaks, great. If it breaks a different low, it's not a change of character. Like, it wasn't built on any specific rules. Therefore, you're just going to have completely random results. So I went ahead, and this indicator is built on my exact rules as opposed to just some random highs and random lows. And it does it for you. You can see here, you can see that market structure, H4 is bearish, M15 bearish, M1 bearish, right? It tells you the structure, and it tells you where the changes of character are, where the breaks of structure are, change of character, break of structure, change of character, break of structure, change of character. Instead of looking at it and just not knowing or guessing, it tells you where all the breaks are, where all the changes of character happen, where all the highs are, where all the lows are. So step one is directional bias, and you always want to be trading in direction of the trend. So I'm going to come back before this trade even gets played out, and this is how price looks. I can only trade in the direction of this, and we are M15 bearish. Swing high is here. Break of structure happens here, swing low is here. So we're bearish. So I can only look for sells. That's the first step. The second step is location. So we have direction, and then we need location. Location for me is an area of price, because again, this becomes a whole other concept. If, for example, we are bearish, where can I short from? Can I short from here? A lot of people try to, and then they get stopped out. Can I short here? Can I short here? Like, where in this leg can I short from? Because let's say my average risk to reward for most people, let's say it's 1 to 3. If you get the location of that trend wrong, then you might end up taking 4 losses before you make 1 winner. And so if you take 5 trades, you lose 4 and win 1, you're -1 overall because you've lost 4 and you gain 3. So you're overall in a net negative. So location is super important. You need to make sure that you have an area where you look from. And for me, that is always, if it's a London session setup, so if it's London, then it's Asia session high or low. So if we're bearish, it's Asia session high. If we're bullish, it's Asia session low. In New York, it's London high, London low. So if we are bullish and New York comes, then the low of London, that level has to get taken, and then I can trade higher. So my location is below London low, or my location is below Asia low, or above London high, or above Asia high. This is a London session setup. You can see here, the trade is executed in London. You can see the time right now is 2:15 a.m. Eastern Standard Time, so 15 minutes into the London session. So how do you do that? Well, one way you can do it is just understand the times. We have Asia session, which is from 8 p.m. to 12 a.m. Eastern Standard Time. So what you can do is, here we can see where's 8 p.m. So here's 8 p.m. So Asia opens here, and we don't trade below it. And then where's 12 a.m.? 12 a.m. So it closes here. So it opens here, closes here. So that's my Asia session low. That's my Asia session high. Now, in some scenarios, it's not that clean where the open and close is the high and the low. And then for London is 2 a.m. to 5 a.m. Eastern Standard Time. So again, if I want to look at London, we can see that we have 2 a.m. So London opens here, and then 5 a.m. we close here. So London opens here and closes here. So the high would be here. That's the high. And the low would be here. So that's my London session low and my London session high. And then New York is 7 a.m. to 10 a.m. Eastern Standard Time. So what we need to do is we need to trade only short above this high, because this is the Asia session high. That is what location is for me. Now, again, instead of manually coming in and having to mark the low and the high of Asia every single day, I again input it into here. So we have Asia session, London session, and New York session. And you need to make sure that current week only is not enabled. If you only show current week on a Monday, you won't see the past sessions. So if I just click this, now what we can see is instead of marking out how we marked it, we simply just have in blue, we have Asia, in green, we have London, and in orange, we have New York. And it's the same every single day. So we can see Asia session low and Asia session high. And now you might be asking, why do you use that as your location? And it's because, statistically speaking, I understand a lot of the times London likes to take Asia, and then the rest of the day we trend in the opposite direction. And New York likes to take London, and the rest of the day we trade in the opposite direction. For example, here we can see we have Asia low gets taken and we trade away from it, right? Here we have Asia high gets taken and we trade away from it. Here we have London high, we trade above it and we take away from it. Asia low, we trade below it, we take above. London high, traded above, we take below. So this is just something that I have observed and collected the data on. It's not just some random theory. It works. So step 2 is location, and it has to be above the Asia session range. So London has to be above Asia. And here you can see London is now above Asia. So when you know the directional bias is bearish, you know the location is above Asia, and we've ticked both of those off on your checklist. Again, I like to have my strategy as a checklist. 5 or 6 different things that I just tick. Then number 3 is going to be confirmation. The thing with confirmation is that it's something that can cost you a lot of money. Like, let's say if we are bearish, now we don't just short here, but we have our second rule, which is Asia session. So we come in, we have Asia session high is right here. Now what? Do you just sell as soon as you hit Asia high? So you sell, your stop loss goes here, and then you take a stop loss. You sell again, stop loss goes here, you take a stop loss. You sell again, stop loss goes here, you take a stop loss. And eventually, one of the times, you will be correct. But in the process, you lost 3 trades, and then you won 1 trade, which is plus 3. And so you actually are break even. And then you factor in commissions and spreads, you're probably in drawdown. That's why confirmation is so important. You can see here, for example, when you get a structural shift, then you should go. So here's what that looks like in real time. If I have my M15 bearish trend, and then I have a lot of the times the M1, the 1 minute time frame, as this 15 minute comes for a pullback, that 1 minute time frame right now looks bullish. Then we have, let's say, our Asia range. So we're going to change this. This represents the 1 minute time frame. Here we have our Asia session high. Right now, you can see that the 1 minute time frame is bullish. Now we break the Asia session high, and then the 1 minute has a change of character, right? Where we shift from higher high, higher low, higher high, lower low, change of character. That's confirmation. If we look in here at this time and we go to the 1 minute time frame, you will notice yes, it says bearish right here. And the reason that it says bearish right here is because technically the swing structure is up here to here. So we're already bearish. But that's because we have a huge range, which first and foremost is quite rare. And secondly, we literally have a rule for this inside of the system, which says if the M1 range is too large, we will go to internal structure, because there is pointless trying to trade external M1 when it's that large. It just doesn't make sense. So we also have internal structure, as you can see in here. Internal change of character, etc., etc. So we'll turn this on. You will see in here, internal change of character, internal break of structure, internal change of character. So right now, we had a change of character here. We're bullish. So if I just, again, take this out, the M1 is bullish right now. So I can't just sell in here. I can't just wait for us to have a bearish candle and then just try to sell this move like this, because we're still bullish. So I'm still expecting the 1 minute will trade higher, and it does. But then this happens. As you can see here, we get an internal break of structure followed by an internal change of character. So now the M1 has internally shifted bearish. And because we're using internal, not external, we are now M1 bearish. That is rule number 3. Now we have M15 directional bias, which is bearish. We have our location above Asia high, and we have our confirmation, which is the M1 shift from being bullish to bearish. And now you can see how all of these things are starting to come together to form a step-by-step process for how to analyze price. And all you have to do is literally just follow a checklist. So after we get confirmation, we need step number 4, which is point of interest. Again, what's the purpose of this and why is it important? There are times, for example, this time is a little bit different, but there are times where, let's say your 15-minute is bearish, your 1 minute comes up and it's bullish, and then you have this big 1 minute shift. Now, the POI is basically where inside of this leg do I trade from? We don't want to just break out and trade the breakout, because sometimes the M1 range is so large that it ends up being low risk reward, like 1-to-1 risk reward. So we find an area of interest inside here, like an order block or a fair value gap, so that instead of having a 1-to-1 risk reward, we can increase it to 1-to-4, 1-to-5 risk reward. So now we're looking for a point of interest, and that is always a fair value gap or an order block. You can look at it yourself. You can see that there is a fair value gap in here. You can see that there is a fair value gap here, and you can see that there is an order block here. Right? That's me manually marking it out. Or what I can do is I can just toggle my order blocks and fair value gaps, keep them bias aligned only, so it's in direction of the trend, and it will do it for me. Right? You can see order block and then fair value gaps. And then I can choose which one I want to trade from. In this instance, I would trade from the order block, and I would put my entry on here. My stop loss goes above the swing high. Why? Because if we now trade through this high, the 1 minute becomes bullish. We're not bearish anymore. So the trade becomes invalid. Now, I need to know, where do I target? Do I target 1-to-1, 1-to-2, 1-to-3? Do I target this low? Do I target this low? Where do I take my profits? And again, this is something that has been properly battle tested and data verified. Number 5 is profit taking. Now you'll notice if you look at my data, I have an average win to loss ratio of a 6.14. Let's say you risk $1,000 per trade. Every time I lose a trade, I lose $1,000. And every time I win a trade, I will make $6,140. That means that with a 33% win rate, which to most people seems low, people don't understand that there is a very large correlation between your win rate and your average risk reward. People want 75% win rates, but then they also want 1-to-5 risk reward trades. You're just not going to get it. The higher the risk reward that you want, the lower the win rate will be. The higher the win rate will be, the lower the risk reward will likely be. Again, that's very common. So profit taking. For me, I have 2 forms of profit taking. I have the swing structure, right? So profit take on the swing low. And then I have a fixed profit take. Why? Because again, logically, if we just look at structure, price puts in a low, a break of structure here. Where do you think price is likely to trade to next? Are we more likely to trade to this high or this low after this break of structure? The data tells us that we are more likely to trade to this low. This isn't just some concept. It's not just some theory, some fluff. It's literally data verified. The data indicates that we are more likely to trade toward this low than we are to trade toward this high. I'm just playing the data game. Therefore, if we're more likely to trade here, then again, there's a lot of chance that we will end up going here. This is a good area to take profits. But sometimes it's so far away that you end up getting caught in the mid-range. For example, like this. There were many times in my trading where I was bearish, right? I get into a trade like this, but this level, let's say it's so far away, and I get into my trade, and then price starts running in profit, and then it just turns around, comes back up here, and then goes from here, right? Same rules, only that I was actually just a little bit too early. The real move to the swing low happens a little bit higher. And I noticed that there was a common theme in here that we were running to a nice level. So many times I was looking at price and it was 1-to-4 back to break even, 1-to-5 back to break even, 1-to-6 back to break even, 1-to-7 back to break even. And no one wants that. Who wants to be up 7R and then price comes back to break even? And trust me, I've experienced it a lot of times. So one of the rules I introduce is I always fix profit at 5R. I'll take my money off the table at 5R. And then I will leave the rest of the trade to run to the swing low. So for 12R. So in this specific scenario, I have 5 and I'm going to close 50%. So 50% of 5 is 2.5. So this is the first target is for 2.5%, right? Assuming you're risking 1% per trade, right? But it's going to be 2.5. And then this one is, let's say 12, 50% of 12 is 6. So this target is 6%. So I have two profit targets. One is 2.5%. The other returns me 6%. And this way, what I found is that even if we end up coming down here and then we go back up here and then we go here later, I still got my 2.5%. Instead of seeing price run like this and then do this and I got nothing. But I also allow, because price a lot of the times does take the swing lows, I allow my runners to run. This way, I don't have the pain of waiting for break even, and I don't have the pain for closing my full trade only to then go and watch it run a lot lower. So I balance it. And what I personally like to do again is I like to target liquidity. In here, you can see enable liquidity levels, previous day's high, previous day's low, previous week's high. So you'll see that this low down here is actually previous day's low. So that's a good target for me as well, previous day's low. Again, even if we look at the daily time frame, realistically, the daily time frame is only going to go in one of two directions. It's going to trade higher than the previous day, lower than the previous day, or it's going to stay inside of the previous day. And then the next day, it's going to trade higher or lower than the previous day. Look at the size of this bearish candle. This is yesterday's bearish candle. Again, this is another bit of data I have. You see this in here, this directional bias? Well, this tells you that is the weekly candle more likely to go below previous week's low or below previous day's low or above previous day's high and above previous week's high. And this has 10 years of data backed behind it. So I know that with 10 years of data, there's a 75% likelihood that this previous day's low gets taken today, tomorrow, the next day. I like to be someone who trades from a data standpoint, not just an opinion or randomness. I just don't think it will help you long term. And those are the 5 steps. And notice that they're step by step. And notice the indicator does them for me at this point. I used to have to do it for myself. I've made errors myself and stuff like that. But the point being is step number 1 is directional bias. I use market structure to determine the bias. Am I bullish or am I bearish? And instead of relying just on my opinion or just on how I see price, I built a set of rules that are repeatable and I put them into the indicator that does it for me. It's the indicator that I use for myself personally that does it for me. And if you're wondering where you can get that indicator, I'll leave a link in the description of this video. You can check it out. Again, for location, I use the Asia high or low or the London high or low. Again, for me, I just put it into my indicator because why not? Confirmation, lower time frame shift. Again, put it into my indicator. Point of interest, fair value gap or order block, always put it into my indicator. And then profit taken. The swing low, 5R, previous day's high, previous day's low. Again, put it into my indicator. So that's why I built it. I built it for myself because it just makes my trading easier. Now that I have it, I literally couldn't live without it. Along with the indicator, I also want to give you my full trading strategy. So in this trading strategy that I've just shown you right now, this is one specific setup. This is the London Sweep Frankfurt setup. I have another 5 different trading setups. And again, in the description where you can get the indicator, as a part of that, you also get all of my trading strategies, all the different model variations with the step-by-step trading and years of backtesting of me actually backtesting. Link is in the description. You can check it out. But this is one of the setups, probably one of my favorite ones. And then we can see how this plays out. Price comes back. Now we're tagged into the trade. Price runs away. We can speed this up to the 5-minute time frame. So you can see that price tags us in and starts running nicely. How we came very close to our take profit and then we reverse, but we trust our analysis. Then we hit our first take profit, so we close half of the trade, and then you let the rest of the trade run to the swing lows. And you can see how much this trade literally just melted off. And again, this is a trade that was taken with members live in the live trading floor, but here you have it. This is the exact trade, 15-minute breakdown. And then you've already seen, but you can see again, all the people that took the exact same trade.